All right, so this is the explanation for the gold strategy that I trade, which is in the 4-hour time frame. So we are in the gold chart, which is this one at this point, but that doesn't really matter. I am going to show you what the strategy is in theory with some funny lines that I will draw in here. All right, so let's say we have a trend moving upwards. We can identify an uptrend simply by looking at the market, and we see that the market is moving up. That's all an uptrend is. And what we are waiting for is a consolidation. A consolidation means pretty much just that the market is moving in a very small area. So this is where the market is stuck, and we want to trade the move outside of this stuck place. So we are at a high point. The market moved upwards. Now we are at a high point. And what we now want is an engulfing candle, which would look like this. We have a candle which moved down at a high point and which engulfs the previous candles. So this is only like a zigzag line, but just imagine these are all candles. I will show you a situation in the market here at the end. And so this is what we want. We have an engulfing candle, meaning this candle engulfs the previous ones in the consolidation. What we now do, so this is a bearish candle, meaning the market has moved down, it's fallen. The candle opened at the top, moved down, and closed right here. On my chart, in my color pattern, it's a black candle. What we do now is on TradingView right here in our toolbar on the left, the third icon is the Fib retracement. Fib is short for Fibonacci. And so we click on it, and because this candle made a move downwards, we place our Fibonacci at the top and pull it down to the closing of this candle, which is at the bottom. And now I have a single line in here, which is red, and it says 0. Hold on, let me move that to the side, which says 0. Can't see that. Okay, hold on. Okay, this line says 0.618, meaning that this line marks the 61.8% retracement of this candle. So the market moved down, and now if we take a look at the distance that the market would have to make back up of this candle, that will be 61.8%. So if I move this, the 61.8% is obviously relative, and so this that also moves with the movement of the start and the ending point of the Fibonacci retracement. And all we want to do is enter the trade at the 61.8 Fibonacci level. So once more, we have a trend, a consolidation, and we have a break out of this consolidation with an engulfing candle. We place our Fibonacci, and what we do now is place a limit order. In this case, this is a bearish candle, so we want to sell the market because a bearish engulfing candle shows us that the selling pressure at this point is very large. The market doesn't want to be at this place. That's why it moved so much. And so we want to sell the market because we want to move with the market. What we do now is we place a sell limit at the 61.8% Fibonacci level. So right here would be our sell limit, and we place, hold on, there we go. We place our stop loss above the highs, and our take profit would be twice the size of our stop loss. How can we see that? When we have this number right here, which would be 2. Okay, let me enter it a bit more clearly. Let's say we have a 30 pip stop loss. Double of that would be 60. So there we go. We have a 60 pip stop, 30 pip stop loss, which is 300 ticks in here, and a 60 pip take profit. And that's it. We obviously have the same strategy in the other direction. So if we have a move downwards and then a consolidation, now we are waiting for an engulfing candle again, but now we're looking to buy. So we are waiting for an engulfing bullish candle. With my color pattern, this candle would be white. I think the standard trading view pattern, color pattern is you have a white background, and then you have green candles for a rising market and red candles for a falling market. But yeah, you'll figure that out. So we have a bullish engulfing. We have the same thing. We are stuck at a place in the market, which is this one right here, the consolidation. We are, moving in one small area, and now we get a lot of buying pressure. So this is a very large engulfing candle. The size doesn't really matter. It's just relative to the previous candles, we have an engulfing candle. So what we do now is we take our Fibonacci again and place it at the bottom of the candle because we want to buy, and we pull it up to the top of the candle. Boom. And now we want the market to come. You see this candle's the 4-hour candle. Again, we only do this in the 4-hour chart. Now we place a limit order at this level, at the 61.8% Fibonacci level. And so we are placing a buy limit. We hope that the market comes back down, activates our buy limit, and moves up. That's the theory, which would look like this. Where are we at? There we go. And so again, we want our, when we sold the market, we wanted to place our stop loss above the highs. Now we want to place our stop loss below the lows. So let's take the same example, 300 and 600, 30 pips and 60 pips. You'll figure this out. I mean, with gold, the numbers always vary. Right here it says 300. In here it says 3,000 and 6,000, but it's actually 30 pips. But yeah, you'll figure this out the more you do it. And so this is our buy limit. We place our stop loss below the lows, and the take profit is twice the size of our stop loss. That is pretty much it. We have one more entry signal, which would be a specific candle that would be the shooting star. And the shooting star, let me show you real quick, is the following. The shooting star is this. So we have a move up, but instead of a consolidation and an engulfing candle, our entry model is now simply 1 4-hour candle. This wig tells us where the market has been. So each candle usually has a wig. I mean, this is drawn by me, so they don't have a wig, but you can tell by the wig where the market has been. And this large wig to the top tells us that this candle in the previous 4 hours was moving up, 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 up. But within the time frame of 4 hours, because we are in the 4-hour time frame, the selling pressure in this case was so large that the candle, even though it was this high in the market, still closed bearish, so in negative compared to the opening of the candle. And in this case, we are not waiting to hit a Fibonacci level. We are selling immediately. And the same goes for the bullish example. So right here, we are going short. So we're selling the market. And this is the same thing. In here, we had a move downwards. The move, these would have to be black actually, and these would have to be white. But yeah, don't get confused by that. So the market moved downwards. We moved down, 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 down. But there we go. But the buying pressure was so high that this candle still closed bullish. So compared to the opening of this candle, which would be down here, the candle still closed in profit. And again, we can tell by the wig that this candle was in a negative amount compared to the opening of the candle. And so again, we enter immediately. So we buy the market immediately. And in these cases, we want our stop loss when we buy the market, again, to be below the low or above the high when we're selling the market. Let me show you an example in the market. A beautiful, beautiful example for a shooting star is this one right here. These don't come up often, but it does happen. So we have a move up in the market, and we actually have somewhat of a consolidation as well, but also we have a shooting star. So the market or the candle opened at this level. It moved up, 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 up for, I don't know, let's say 3.5 hours. And then the selling pressure was so large that it still moved down. Okay, I'm just going to move over here, but I'm still at this candle right here. The selling pressure was so high that the candle moved down, 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 came back up a bit, but still closed bearish. And so again, we sell immediately. In this case, it would have looked like this. We place our stop loss above the highs. So in this case, 80 pips. Let me enter that real quick, which is 8,000 ticks. And then our take profit is twice of our stop loss. So 1,600 ticks, which is 160 pips. You can see the market moved up just a little bit and then moved down immediately. Yeah, so that's why we don't wait for a correction to the 61.8% Fibonacci level, because this shooting star tells us that the selling pressure in this case, with the bullish example, the buying pressure is so high that we can enter the trade immediately. And that is the strategy. We have the engulfing pattern, which would be this right here. Here's another example. We have a consolidation, so a move downwards, a bearish trend, a bearish trend. We had a consolidation, and then we had an engulfing candle, which would be this bullish white candle. What we do then is take our Fibonacci, place it at the bottom of this candle, pull it all the way up, and our buy limit, because we want to move with the market, bullish, we want to go long, we place our buy limit at the 61.8% Fibonacci level, place our stop loss below these lows. This one would be too much, so below these lows, and that is it. Same goes for the bearish example with both shooting star and the engulfing pattern. That is it. We don't do anything else. That's the 4-hour gold engulfing and shooting star strategy.